In this video, we will look at Disney stock. Disney is down from almost $200 to $95 at the moment of writing the video. So the question is Disney a good buy at this price level? Can it fall even further? So we will look at two scenarios, one bullish, one bearish, and we will compare the valuation that it was during the financial crisis to right now to see if Disney can fall even further. So we will use two projections in our calculations of fair value. So we will try to come up with the fair value of Disney stock using the bullish and the bearish case scenario. So let's get started. First of all, if you want to get updates about Disney or other investment ideas, you can subscribe to the channel by pressing the subscribe button under the video. You will not miss a single new video. Okay, if we look at Disney chart, we can see that the stock is down from almost $200 to $95 per share. So the question is the stock a good buy at $95 per share? To answer this question, we will use two projections, one bullish case scenario and one bearish case scenario. So in the bullish case scenario, we will compare the valuation that it was during the last 3 years. We will use enterprise value to EBITDA as a valuation metric. For the bearish case scenario, we will compare the valuation that it was during the financial crisis of 2008. But first, let's look at some numbers of Disney. If we look at Disney's latest 10Q report, we can see that the total revenue was close to $20 billion. $13.6 billion came from Disney Media and Entertainment Distribution, and $6.6 billion came from Disney Parks, Experiences and Products. If we look at their operating income, we can see that they have $1.9 billion from Disney Media and Entertainment Distribution and $1.7 billion from Disney Parks, Experiences and Products. So for Disney Parks, in the recent quarter, they had much higher margins. If we look at the profit margins, we can see that they are declining. Their gross margins have declined from 45% to close to 34% right now. Their operating margins have also declined from 25 to around 7 in the recent quarters. Disney also increased their debt. We have rising interest rates, high inflation, and this all visible in Disney's numbers. Okay, this brings us to the question, is Disney a good buy at this price level at $95 per share? First, let's look at current valuation. We will use enterprise value to EBITDA as a valuation metric. What is enterprise value? It is market cap plus debt minus cash. So we get the enterprise value of $212 billion. I took the current market cap and took cash equivalents, long-term and short-term debt from the recent balance sheet. Analysts are projecting for the EBITDA to be around $18.7 billion in 2023, which gives us the valuation of EV to EBITDA of close to 11.3. Okay, let's look at the bullish case scenario. We take the current EV to EBITDA multiple of 11.3. We use the current price at the moment of writing the video of $95. We use the EV to EBITDA multiple of 20. This is close to where Disney traded for the last 3 years. It traded even higher, but to be on the safe side, we will use the multiple of 20. In this case, we get the fair value of Disney stock of $168 per share, which implies an upside of 77% from the current price. If we use the EV to EBITDA multiple of 7, which was during the financial crisis of 2008, we get the fair value of Disney stock of $59 per share, which implies the negative upside of 38% from the current price. Okay, we have looked at two scenarios. In the bearish case scenario, if Disney were traded at the same multiple that it was during the financial crisis, it still has room to go down. So it still has negative 38%. History shows that at this multiple, it was a great opportunity to buy the stock. In the bullish case scenario, if the stock traded at the same multiple that it was during the last years, we can see a 77% upside from the current price. So we can see an upside of 77% and the downside of 38%. So I believe for long-term investors, Disney provides a great opportunity to buy the stock at this price level. You can have a 77% upside, but we also need to consider the risks that if the valuation will be the same that it was during the financial crisis, the stock can fall even further, around 38%. Personally, I'm not planning to add Disney to my portfolio. I have another streaming stock, Warner Bros. Discovery. I believe it offers a much higher upside potential. Here's the video about the stock. If you are not subscribed to the channel, you can do it by pressing the subscribe button right here. You will not miss a single new video. Thank you very much for watching till the end, and see you in the next video.